Welcome to the Goblin Hideout, the NFT Finance Podcast. My name is Terry, and I'm joined by my co-host Helmus. And today we welcome Kevin from MakerShaker, a community-driven lending platform.
Hey, Kevin, how's it going? Before we jump into MakerShaker, would be great for you to kind of jump into your background and tell our listeners a little bit more about yourself.
Yeah, great. Look. First off, guys, thanks for having me on your podcast. Appreciate it. Keen to tell you guys what we've been up to and what our plans are. So in terms of your question, Ryan, background, I've been personally in asset-backed finance about the last 20 years or so. For the last 7 years of that, I was running a regulated lender where we were focused on kind of relatively volatile assets, and we were doing short-term loans against those assets. So there's a lot of parallels there in terms of background versus what we see the NFT space being.
That's great. And maybe how did you become interested in crypto and NFTs?
Yeah, good question. Right. So look, I've been I've held crypto for about the last 5 or 6 years. Stumbled upon it. We fell into the NFT space really because when we finished up our old lending business, we explored different options for us deploying our capital in less of a transactional way, more of a supportive way. And we didn't initially land on NFT as a concept for lending against, or just the whole concept. We kicked around for about the best part of 6 or 9 months this idea of kind of a human IPO, taking an equity stake in individuals and supporting them that way in less of a transactional approach, really. Where we thought that if we took an investment in an entrepreneur, we could help them grow, bring our network to that person or those people. But we decided to pull that for a couple of reasons. One, it's very easy to get the optics wrong on that, the concept of taking a stake in an individual. And I suppose secondly, we approached different regulators globally on the concept. Some we had a relationship, some we didn't. And the feedback really was they felt it was regulated and they didn't like it at all. So we then looked at other options of backing entrepreneurs, and we fell upon NFTs, really, because principally what NFTs were doing is they were empowering people, entrepreneurs, artists, holders of IP, in order to create value from their creations. And I suppose naturally, we then fell into lending against those NFTs.
Yeah, that makes sense. And maybe it's a good time to jump into MakerShaker. So, I guess part of your inspiration was driven by historical work experience, but maybe you can tell our listeners just a high-level overview of what is MakerShaker.
Yeah, so just 60 seconds on us then. We view ourselves as a community-led liquidity or finance platform for NFTs. We also view ourselves as being an education piece, and principally our two strands are we're pooling liquidity from the lender side, and we're deploying that alongside our capital to borrowers. Initially, we're using existing P2P platforms. So that's what MakerShaker is as a concept. And I suppose some of our values that we've talked about offline, Ryan, in the past, are delivering better outcomes for borrowers, being fairer to borrowers. And we think that we can do that within an environment that we create.
So maybe we can jump into the current state of the NFT lending platforms today. I guess what's your perspective? Because the space is competitive, right? And curious what your perspective is from both a lender and a borrower. On the current state of lending platforms.
Yeah, thanks. I mean, the first thing to say is we're predominantly focused on this P2P model. We haven't used and don't intend on using kind of P2Pool. We think P2P is the model principally because what we're focused on this borrow outcome piece, right? And we like the way that, for example, Nifty Fi and Arcade what that outcome looks like for a borrower. They have certainty. They have a term. That they understand really what the terms of engagement are, and they can't be pulled out of a position. So I suppose maybe if I focus on the P2P aspect when answering that question. So look, we've been using NiftyFi and Arcade probably since about March or April of this year. And we see, look, whilst it's a competitive market, what these platforms have done in a short space of time it is incredibly impressive. And you've got a lot of liquidity that's landing on these platforms, both NiftyFi and Arcade. You've got incredibly secure platforms. Yeah, there's some UI experience issues, but on the whole, you've got secure platforms with lots of liquidity. So those are the positives. And we're really pro that. And that's why our protocol, we're overlaying really what those platforms are doing. We're not trying to reinvent the wheel. But I suppose where we got involved and where we see maybe where we can add some value in a helpful way for those platforms is we see that price discovery on those platforms historically has been quite inefficient. It's quite mechanical as well. And it's also complex. If you're a lender and you're trying to deploy capital, it is, and yes, you can run through an API, but it is problematic deploying that because it's a bit hit and miss, right? So that's from the lender perspective. And then and that's why we think that pooling our liquidity and having a bit more of a platform where we can engage people, there's a bit of a value add there. And we hope that we can close that premium or that gap in terms of the price discovery bit. And then I suppose from the borrower perspective, look, we're not a borrower on those platforms, but we see even on the P2P model, you don't have instant liquidity. Now that has improved right in recent months with what Arcade are doing and what NiftyFi are going to do in terms of having these collections where borrowers can get instant access to liquidity. But again, those offerings aren't incredibly liquid. And what we're able to do, we hope, is provide extra liquidity to those collection offerings. So effectively closing the gap in terms of time frame for when borrowers can get access to capital or loans. And then secondly, trying to kind of bridge that gap in terms of the disconnect between what a borrower wants to lend at and what a lender is prepared to put that money out the door at. So that's our view on the market at the moment in terms of P2P.
That's great. And you've mentioned before, and I don't know if it was when we chatted or if it was in some of the materials you sent over, but you mentioned onboarding the next million borrowers. And I'm curious to think from and I know you touched on it a little bit, but I'm curious like what you think some of the low-hanging fruit is to improving like the borrower user experience.
Yeah, look, this concept of onboarding another million people right to the NFT lending space, it's ambitious, right? And it's not just a problem that we're trying to tackle; it's one that you were trying to tackle, and other players in the ecosystem. So we've all got a common purpose there, right? And there's some obvious areas which we're all familiar with in terms of mobile first versus desktop. Integrating wallets. So there's no point in reinventing those. Everybody's familiar with those aspects. But where we see it, there are 2 or 3 low-hanging fruit that we're targeting, really. There's an education piece, right? And there is a lot of education in this space, but it's all dotted around and it's not in one particular area. So what we're trying to do, and we've already started that process, is we're trying to assemble and create our own content, which we hope will educate people, one, that are in this space at the moment, and also people coming in the future. So that's the first piece. Okay. The second aspect of this, in terms of onboarding new people into the space, right? And this sounds obvious. When the 3 of us start out, we normally dip our toe in the water in a concept. If we're looking at lending or investing or whatever it is, you normally don't jump in with 2 feet first. You normally dip the toe in. Right. But the problem that new lenders into this space have got in terms of trying to come into the market, right, is if you've got a limited pool of capital as an individual, you and then the assets that you can lend in may not be blue chip assets. You end up going down the risk spectrum in terms of the types of item that you're lending against. And so you may have not positive outcomes. And we've all seen in the bear market, like a lot of markets really, when you have an event, capital starts to flow to the premium, or as we say, blue chip assets. And that's the same across every market, right? So what we're trying to do is we're trying to create an environment where people who are dipping their toe into the water, they can lend against the assets that they want to, and they can pool their capital alongside ours and still get exposure to the types of assets that they want. And we think that's important, right? And it's we'd like them to stay on our platform whilst they're lending, but as they're learning and we're holding their hand, it's okay if they want to just reach out on their own and directly deploy their capital once they're a bit more comfortable. So I suppose those are two things that we're focusing on. And I suppose the third one really, guys, which is not from the lender perspective, it's the borrower side, is and this gets a mixed reaction in the market, right? But we think it's really important for the next million users. What we have at the moment is, and we'll talk about this a little bit later on, maybe if we've got time, is we have quite a strong, well, there's a number of players that are adopting kind of loan to own strategies effectively. So they're lending upon assets as kind of a mechanism, effectively, of potentially getting hold of those assets at a discounted rate in the event that the borrower defaults. And that may be okay with the current state of the market, but we feel from our side that in order to bring on board this next million users, that borrowers have got to have better outcomes. They've got to have better certainty as to what that looks like. And then that's really why we're focused on this P2P versus this P2Pool kind of protocol, where your asset can get liquidated out. So we want to spend some time, and that's not going to change overnight, right? Trying to differentiate and help deliver better outcomes for borrowers in the event that they can't repay. And for us, that means a few things. It means giving them more time, engaging them a little bit, not having binary outcomes, and those sorts of things, and education, right, around that. So those are really the three kind of main areas that we're focusing on as a business and as a platform.
Yeah, I definitely want to get back to the education aspect, because I think it's one of the most important aspects going forward. How do we get these NFT holders, specifically borrowers, educated on the fact that they do have these options? But I do want to get into the protocol a little bit. I understand you guys are not live yet, but could you give us an Alice and Bob example and some feature sets that you guys are excited about sort of an explanation of how people on the platform are interacting with the platform?
Yeah, look, thanks for the question. I suppose there's two aspects of that. So we have 4 or 5 strands, if you like, to our offering, which we talked about. You know, the education, the liquidity pool, the deal origination, and the rewards system. I suppose that's 4 there. So we are live, right, on a couple of aspects of that. So we have started the education bit, and we also have done our first deal. We did our first deal last weekend. We did a loan for 157,000 USDC across a portfolio in the Yuga Labs ecosystem. Interestingly, it was to the DGen that swept the Renga floor last weekend, so that was kind of helpful in terms of getting some profile from our side. So we are live in terms of some of the aspects that we're focused on. But I suppose your question is really driving at what our roadmap looks like in terms of the protocols and the liquidity piece, right? So what we are doing predominantly on the liquidity side is we're creating separate pools or vaults where people can lend alongside us. And I suppose the process at our end is the initial vaults, everybody will be sat alongside on the same terms, but we will be rolling out in the future different types of liquidity pools where lenders can come in on board and they can price their capital in different ways. So effectively, it's not as simplistic as having kind of traditional kind of junior, senior, mezz and pref equity kind of loans coming into a vault, but it's akin to that. And I suppose other aspects that we are looking to introduce down the line are liquidity pools where maybe people are taking more of an equity stake in what the particular borrower wants to do with those funds. So those are the things that are on the table for us as a concept on the liquidity side of things.
How have you guys thought of dealing with liquidations, especially as you guys settle on P2Ps?
Yeah. Look, so we don't have a finance. So it's easy the way that we're doing it at the moment, right? So and we put a lot of literature, both in our Twitter and the spaces we're doing, and on our website about the way that we'll engage with borrowers in the event that they default. Okay, so we talk a lot about providing them time. We need to be cognizant of we need to protect our capital as a lender, right? But that starts from the origination side, making sure you're lending at the right rate. But assuming we end up in your scenario that you've laid out, where we are having to default, we're still going to give borrowers time. But effectively, under the P2P model, what we're saying is that if that time runs out and they do default, what we're doing is when we sell that asset in whatever format we think is appropriate, we'll return to borrower any surplus over and above the debt that's owed. So that's something unique, and obviously that's off platform, so that's not on Arcade or Nifty-Fi, but that's an assurance and an undertaking that we're giving to borrowers. So that's the existing model that we've got. As we move into our pooled liquidity pools and we end up in liquidation events where we have lenders that are taking different types of risk, we haven't finalized what that looks like. But something that's important to us is, one, we have to, those values that we've just talked about 5, 10, 15 seconds ago, we have to remain true to those in terms of the way we engage a borrower. But also, for example, if you've got a lender that's come into our pool and they're a higher risk, they need to be preferred in terms of the decision-making and the hierarchy versus someone that's a lot more secure. So we have concepts that we've talked around internally for the way that liquidation process and decision-making will look. And we hope that those will be fair to the lenders, and we hope that those will be fair to the borrowers as well.
Gotcha. And as you guys think about decentralization in terms of having vaults be permissionless, how have you guys found architecting this solution? I guess, what are the challenges? What have been some unique solutions that you guys came up with?
Yeah, look, it's a difficult one. I mean, we don't have all the answers to that question, right? I suppose what we're doing at this very first stage, right, is we have a lot of people which we've been surprised at a little bit. And I know, Ryan, we talked about this offline in the past. We've seen a lot of people that have got liquidity that want to deploy it into this space, that are keen on the idea of coming into our vaults, right? And then because we're not up and running with our protocol, at the moment, our vaults, we're constructing around Gnosis or safe multi-sig wallets with different signatories. And so there's a process that we're going through internally, and that's not an architecture point, right? That's just a conceptual point. And it is interesting that different community members have got different tolerance level and different pain thresholds around, one, the amount of information that they're willing to provide, or other signatories signing off on a wallet. So these are all things that we're coming across and trying to work through. But we think that with the support of the community and the people that we've onboarded already, that we can see our way through to those. For example, our first vault, we were able to create that in a way that everybody was kind of comfortable with. But we do see as different lenders come in with different kind of pricing requirements, that they will have different desires in terms of the way that architect and that protocol works. And they're going to be complex issues, right? And we don't have all the answers today, but we think internally that we've got the appetite to work through them.
Yeah, that's great, Kevin. And then maybe zooming out a little bit, where do you see NFT finance progressing over the next 12 to 24 months?
Yeah. So this, right, I answered this question a couple of different ways, Ryan. But when we were doing our traditional lending business, peer-to-peer lending, right? Peer-to-peer is not new, obviously, to NFT finance. Peer-to-peer has been around in existence for 10, 12 years. And what happened in that market, traditional P2P, lending is you had initially everybody coming in the same format as to what exists on Nifty Fire and Arcade. And over time, there's a few things that happened, and we see similarities in terms of what played out historically in P2P as to the way we think this will play out over the next kind of 12 or 24 months. So what that means is that you ended up in the traditional P2P with platforms focusing a bit more on institutional funding as source of liquidity, family office funding. And we're starting to see elements of that already. I mean, us coming in, for example, as a liquidity provider is one example, but there are others. I mean, what you guys are doing at Goldman Sachs, there's lots of others that are moving into this space. So we do see this move as more liquidity is needed into this space, focusing on different types of capital being deployed in this space. So I suppose that's the first big thing that we see playing out and continuing to play out over the next 12 or 24 months. I suppose with that, guys, is it just from our learnings from traditional lending, is that as you start going up the curve in terms of the types of capital that comes in, for example, banks, they don't take risk, right? They deploy capital, but they will not take risk on balance sheet. So what that means, in order for institutions to start playing in the space, and this is already happening, right, with a couple of the institutions that are lending against NFTs, they will not take principal risk on NFTs. So what it means is when they deploy their capital, they're seeking in the background a structured arrangement with another player or another fund, where that fund, for example, will take those assets off them at par, so that the bank is totally de-risked. And I suppose that's a positive in terms of the market for liquidity. But we do see some issues with that, right? As different types of liquidity starts coming in. At the moment, historically, what we've had is degens and real risk takers taking principal risk when they're lending money out. But as different types of capital start to come in, the borrower isn't going to have visibility on what that internal dynamic at their end looks like. So, for example, you have institution coming in, but they've underwritten it with someone taking them assets off in kind of more of a loan-to-loan type of arrangement. And we just need to be cognizant of that. So more liquidity for different types of players isn't always good, but we see it moving to that model because that's what happened in P2P in the real world, and we think that's what's happening already.
And just to close it out, what's next on the roadmap from both like a product and marketing perspective for MakerShaker?
Yeah, sure. Look, so from a marketing perspective, really, it's continue to build up that education piece. We're not trying to hard sell or shill to anybody. So it's doing that education, doing good quality deal flow and origination so that people can see the types of deal we're doing, and slowly start to reach out on a one-to-one basis with people, as well as putting that education bit out. So that's the marketing. And in terms of the product development bit, we're pretty focused on the community aspect and the reward systems. So initially, we're going to work with the community to hear back from them, really, in how they feel that they want to get rewarded as both lender and borrower, so that we have one, they're properly remunerated for their time. Secondly, so that their interest is aligned with ours. And then thirdly, so that we can kind of have sticky capital on our platform. So I suppose that's the first initial stage in terms of the product. And then further on, just to kind of close out for next year, it's tackling those liquidity pools and the architecture piece around that, and also the dynamics around it. So those are the main things that we're focusing on, short, near, and long term.
And then for our listeners, is there any way they can get involved with MakerShaker? Where can they go read more about you guys? How can they join the community and participate?
Yeah, look, thanks for asking that. I appreciate it. So we've got the website out there. It's makershaker.xyz. You can click on our Twitter from that site. You can join our Discord. We've had a lot of people join the Discord and they're kind of kicking around. You can open up a ticket if you want to engage us individually. And we have some forms that you can fill in as well on our website, as well as just kind of following us on Twitter at Real MakerShaker. And me personally, Cabal, I'll link in after this podcast. So we have some literature out there, but there's lots of ways of reaching out. And we're keen to onboard community people because we are trying to develop and steer what this product looks like. And we need other people's help in order to do that. So it'd be great to have people on board.
Awesome. Kevin, really appreciate your time today. And listeners, go check out MakerShaker.
Thanks, guys. Thank you.
Follow me on Twitter. I'm 0xTayTayHoho on Twitter. That's Tay with an E. And you can follow Ryan at _Helmass.
Yeah, and that's _HELMASS. Thanks everyone for tuning in, and we'll catch you soon.